All right. Hello, hello. Welcome to my channel. Let me see if there's any music playing. I think there's music playing just to kind of warm it up. Hi, everybody. I'm Mike Patel. Welcome to Home Savvy Central, my weekly live on Mondays at 4:30. I used to do it at 5:30, but I'm doing it at 4:30 because of a schedule change. I may get back to 5:30 in a couple of weeks. I'll keep you posted. But we have, like I always say, a very exciting program. Otherwise, I would not be doing this live. It takes a lot of time, a lot of research, a lot of data, inviting guests. It's a lot of work. So we are serious about this program. We are always very excited. And we say we have an excellent program this week, which we do. Today, we're going to talk about home equity and the hidden trap. What is that hidden trap? Well, the hidden trap is now you're going to be end up paying capital gains tax. I'm not an accountant. My guest Matthew, I'll introduce shortly. He's not an accountant, but we're going to talk about some things. What we want to stress is how equity is very good for you, how we have gained so much equity. In general, our equities have, depending on how long you've owned your home, if it's 20 years, you probably quadruple your equity. If you bought it like 10 years ago, you probably doubled. And if you bought it 2 or 3 years ago, you're probably up 20, 30%. Regardless, we have a lot of equity. That means we have a lot of money in our house, in our property, whether it's your owner occupied or your residential. But when you sell, and if you sell, watch out, because you have a certain tax breaks, but not all of it. So that's our topic. We'll also talk about the market, how it's going to help you and not help you. But before I do that, let me introduce you to Matthew. Matthew has been a guest with us before. He's from the greater Atlanta area. Matthew, why don't you introduce yourself? Tell us about yourself. I know you're a great realtor, a great lender, but I'll let you do the honors.
All right. As you were told, my name is Matthew Sher. I'm over in the Atlanta metro area, and I've been selling homes for about 22 years here. More specifically, I'm in kind of the northwest suburbs of Atlanta, Marietta, and areas around it. I am also a licensed mortgage loan originator, so that kind of gives me a unique perspective because I see the direct tie-in with mortgage rates and everything firsthand,
Right.
and kind of know what's happening before it happens. So
Great. Yeah. And I know, my brother lives in that area, in the Atlanta area. Talking about equity, if you had to guess, you don't have to guess, you know exactly what it is. Have buyers who bought 5 years, 10 years, 20 years ago gained a lot of equity in your neighborhood?
Yeah. We have had just as much in terms of percentage gain, probably about the same or more.
Mm-hmm.
The thing is, I think the capital gains issue doesn't affect us as much because overall our real estate is less expensive. So,
Right.
So really anybody, who would be facing that would have had to have bought a house 10 years ago for more than, 500,000 or so,
Right.
for it to even be potentially a problem. And,
Right.
10 years ago, I mean, 500,000 was a fairly nice house in the
Mm-hmm.
Atlanta.
Right. So can you explain to our guests who are watching and who will be watching what the threshold is? I know Atlanta, California, it's all the same.
Yeah.
So can you explain the 250, the 500, and also
Yeah.
why California is at a disadvantage versus Iowa or Texas are at an advantage? So the guest or the audience knows what's going on and what the consequences are.
Yeah. Well, basically, the federal government has a tax exemption. Normally, when you buy anything, if you buy stock in the stock market or whatever, and it goes up in value, if you make an investment in something, Uncle Sam comes knocking on your door wanting whatever percentage of the gain that you got when you sell. Same thing with real estate. If you buy a house for 500,000 and sell it for $1 million, it's a capital gain. You actually earn money and you get taxed on that. The one good exemption, which the government put in place because they wanted to foster home ownership and encourage home ownership versus renting, is they give you an exemption where if you're single, filing, a single tax return, you get $250,000 gain exemption. So if you buy a house and you sell it for $250,000 more than you bought it for, you don't owe any capital gains as long as the property was used as your primary residence for, I believe it's at least 2 of the most recent 5 years.
Correct.
And if you're married filing jointly, you get twice the exemption. So instead of 250, you can actually sell your house for 500,000 more than you bought it for. If it's your primary residence, no tax consequences. So that's a great way it's always been a really good way for people to make money tax-free.
Right.
And I've had clients that have purposely bought a new home every 2 years because you got to live in the house for 2 years. But there are house flipping clients of mine that they'll buy a house that stands to gain some value by fixing it up. They will live in it for 2 years while they renovate, and then they'll sell it and move every 2 years. All of the profit they make on that house is tax-free income.
Exactly. So now, just to be clear, let's say I'm a flipper. I'm not, but as an example, so I bought one house, flipped it, California, we make 100 grand. I bought another one, made 100 grand. My third one, I'm over 250 now. So is it cumulative or is it per incident?
It's per incident.
Is it?
As far as I understand it, I'm not an accountant, but the way I understand it is it's on a particular property. You have a cost basis, which is basically what you paid for it. And that resets when you buy a new property. Now, there may be some differences if you were doing some more complex things like 1031 exchanges to buy one property and replace another. The gain may follow you in that circumstance, but I'm talking about just a straight.
You still have to stay 2 years in there, even if it's.
Yeah, but I'm straight up, lived here for 2 years. I'm selling this house. I'm making $499,000 tax free. Then I go buy another house. I can make another 500 and not have to pay tax.
Okay. Right. And if it was a rental, in the last 5 years, you can stay 1 year, rent it out, and the 5th year you can stay. So as long as you stay 2 years out of the last 5 years, even if it was a rental, it counts as a primary residence. Just want to be clear on that, right?
If you bought it as a owner occupant property and you do that, then and you become an accidental landlord, then yes. But technically speaking, while people do it, I think if you bought the home with the initial intention of renting it out as an investment, you might technically be. Now, I'll bet a lot of people do it and get away with it because like all tax things, it's whatever you report. And if they don't have a way of knowing that you're not, you can always basically play dumb and say you didn't know. And a lot of people do it. But I think technically I would be cautious about if you bought the property with the intention to rent it out and make money on it. I personally would probably not try to achieve a capital gains exemption by moving into it later. But I would have to consult an accountant to really know.
Okay. So here's a question for the viewers. 2 questions. One is, if you want to sell your home today, could you, without getting punished by taxes? I want to find out what city you're in, what state you're on, and if you had so much gain that if you do sell, if you're single, you'll get taxed, or if you're married, you'll get taxed because the gains have been so much, which is a good thing. The second thing is, are you one of those sellers? And one of the things I want to talk about, maybe we'll talk about as we go along. Are you one of those sellers that is equity rich, very, very high equity, but cash poor, in the sense that you have a lot of equity? Like, let's take my example. I bought my house 25 years ago. It's it's quadruple. If I sell today, my gain is more than 500,000. So I'll pay tax on it. So if I go and buy something, I may not have enough down payment for what I want because I want to pay cash at my age. I don't want a mortgage. But if I sell for $1 million and I pay 500,000 worth of gain of 500,000 on taxes, which there is, at let's say 30% as an example, that's what, $150,000 in taxes.
Yeah, it's usually 20% for
20% of, right.
most people who are fortunate enough to have that much gain probably are going to be in the 20%.
15 to 20, right. And it depends on your income level too. So
Yeah.
what I'm saying is, are you in this situation? So let us know, make some comments if you're watching live, if you have any questions, or make comments. And if you're watching this after the live or recording, which goes on YouTube and other channels, make comments, ask questions. We'll be glad to answer them. But we would like to find out, do you have a lot of equity that if you do sell, you end up paying taxes? We don't want to know how much and all that, but let us know so that we can participate. But one of the things, Matthew, I want to start with is, let's look at the market, what's happening in the market. Let's talk about the market, where it's headed, where is your equity headed, because the more prices go up, the more equity you have. But there's talk about saying, hey, market is slowing down, it's becoming a buyer's market. If it slows down, then you lose the equity. So I want to share a screen and let's talk about the market briefly. I'm going to bring up something here. Redfin. Let's look at what's happening nationwide. Let's talk about supply right now. Let's see. You can see the screen, right, Matthew?
Yes. Yeah.
Okay, so let's talk about the housing supply. You're a lender. You talk to a lot of brokers and in your customers or clients. What's happening with the inventory, and why is it so important that this over here, it's pointing up? Look at the last 5 years. It was over here. It went down in 2022, way down. And now look at this, in about a year, it has gone up. So what's the significance of inventory overall?
Well, in layman's terms, it all comes down to the sole thing that determines the value of a house is supply and demand, just like any other. It's the most basic economic principle. And if there are,
right,
the reason we've had such equity gain that you're talking about is because of the troughs there on that where it was way low and there was not any inventory. Okay. So the fact that the inventory levels are ticking up is a direct indicator and a predictor that as those levels rise, we are likely to see some slower appreciation on the houses. But what I would absolutely like to point out, a couple of things on this chart that people gloss over. First of all, you'll notice the waviness of it. Every year is an up and down, and that's the seasonal variation. So it's quite normal for inventory to rise in the summer months and then cool, around Christmas time. Okay. And that's what you're seeing there. That's why it's kind of a continuous flow of up and down. And the other thing is, if you look at the top where we are now, it's right about in line with where it was at a time when we were not flooded with inventory. So if you were to look, this chart doesn't let you go beyond 5 years, but if you were to go 20 years or 25 years, you would see that where we are on this right now is still way, 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 way below, like, 500% below where we were in 2008, 2009 during the housing crash. So I do see people taking charts like this and kind of making false prophecies about how the market's crashing because inventory is rising. I mean, that's not a very significant rise, and it's still way below average levels of inventory, and we still have a shortage of housing supply. So I just like to point that out.
That's a good point. And look at the increase. If you compare it to last year, inventory is up 16%, which is a big chunk, right?
Yeah.
See this? I know in the last 5 years, if you look at 2017, 2018, we were much higher. If you can see the graph, we were probably around here somewhere, graph wise.
Yeah.
So we went down all the way down, but it's coming up here, but it should be here compared to 2017, 2018, which we're not.
Exactly.
Right. Let's look at
in 2008, it was probably off the chart, like
off the chart.
way.
It was like, oh my gosh. Yeah. Month supply. Well, let's talk about it since you brought it up. And I can talk about it briefly. Right now, the month supply inventory is about 3 months. What it means, which it means is that if no other homes come on the market today, all the homes on the market, right, it'll take 3 months to sell the inventory, assuming they're priced right and location and all that. In 2008, that 3-month supply was a 1-year supply. That means if you put your home on the market, I would tell the seller, Mr. Mrs. Seller, I'm sorry to say this, but we're going to be friends for 1 year. You may not like me that much on the 12th month.
Right.
It's going to take a year to sell your house. And it did take a year. I mean, there were so many listings that canceled. While we were listed, I had 3 listings where they went into foreclosure because they could not make payments. And we were trying to sell, short sell. And I'm sure you had that too.
Oh,
So
yeah.
during the listings, they went into foreclosures, you know.
Right.
So we had a lot of things happen. But I want to look at something else over here, which is the demand, right? Demand is how many homes are in escrow. Let's go back 5 years. And I'll let you talk about this. If you want to talk about how it impacts the future price, like what's going to happen next year, if it goes up or down, it depends on the pendings right now, which affects my equity, right? Going up or down.
Yeah. Well, it's like we said, it's supply and demand that work together. So if you have higher supply, but also higher demand, you're not going to feel, it's going to feel the same. It's going to feel like the market hasn't changed.
Okay.
If they both move in unison.
Right.
But if you have the same supply, but demand drops off, you're going to feel the pain as a seller, because now you're same number of homes competing for fewer buyers' eyeballs.
Right.
And, you know, so it kind of works like that. And our demand is what we have right now is a weird situation for the past several years where both supply and demand are kind of down. Okay. Supply is going up, but it's not back to fully where it was. But demand is also very low.
Right.
So low supply and low demand is still keeping us at that 3-month supply of homes, which is a healthy, you know, market. But it feels like the bottom fell out because there's just not a lot of transactions, period.
Exactly.
It's a stalemate between your buyers sitting on the sidelines and sellers not wanting to sell.
Yep.
So the number of people where there's a meeting of the minds and they're actually, you know, transacting a deal is lower than I've seen in my entire 22-year career. Actually.
Exactly. Right. And I just put up another chart, you know, talking about the 2 things are happening. On one, if you look at this over here, median sales price has gone up from 1 year. That means this chart was produced, I believe, in May. Anyway, 1 year ago, prices have gone up almost 1%, right? But at the same time, the number of homes sold has gone down by almost 5%. What does that tell a regular seller or a buyer or a typical consumer? What does that mean? I mean,
it means that the doom and gloom stories that you're hearing about the market crashing are not true.
Okay.
And that, you know, people love to take, because we were increasing the value of homes was going up at a clip of, you know, 20% per year, which is almost 2%, you know, 24% a year is 2% per month. Which means $1 million house, you know, is what is that? $20,000 in 30 days. You know, so $1 million house is worth $1,020,000 30 days later, right?
Yeah,
it was going up that fast,
very fast. Yeah.
So what's happened is the rate of increase, because now we only have a 1% gain instead of a 20% gain. So the rate of increase is much lower, but the media tends to like make doom and gloom stories and make it sound like the home prices are falling.
Right.
When they're not, they're actually not rising as fast as they were rising. But there's a very big difference in that. And I see a lot of irresponsibility in the coverage about this.
Right. Yeah. Absolutely.
You know, that and the other thing that gets me is the use of median home price, because median home price does not mean that they used to say in 2008, I saw this, they would talk about the median home price fell by 10%. Well, it doesn't mean that the $500,000 home is only worth $450 now.
Right.
It lost 10% of its value, but that's what the public would hear. What it really meant is lower end properties were selling better than higher end properties.
Exactly.
So the median is nothing more than if you take all the homes that sold and you put them in numerical order by price, and you choose the one in the middle. It's not even the average, but
exactly.
So you could have, you could have 100 sales, 95 of them could be over 5 million, and 5 can be below 1 million, and your median is going to be over 5 million, even though the average may not be.
Exactly.
So,
it is confusing. That's why we talk about these things, because it's very, very confusing. And our concern is equity. Is equity going to go up? Is equity going to go down? And that's why I want to bring this stats up. So if somebody's thinking about selling, they have the capital gains to worry about. They're going to say, hey, well, my house is worth $1 million, but maybe next year, if the market drops 5%, it'll be worth less 5%. Then automatically I lose $50,000, $60,000 just like that. And that's a lot of money, right? For a down payment, or if I'm retiring, I have to pay capital gains tax. I have moving cost. I have fix up cost. Now, if I decide to go to Texas or Montana or wherever, I lose that much money as a senior or as a retiree or as a fixed income. Every penny counts. So these things are very important. There's another slide I wanted to share, and let's talk about it. Let me put it up on there. Let me take this out, remove this, and this screen is going to talk about, let's see. So talking about, you can see the screen, right? This one is as of June 24th, 2025, a couple of weeks ago, from Realtor.com, which we belong to.
I saw this article.
So homeowners face a stiff penalty for staying in their homes too long, a hidden home equity tax. That's what we were talking about. Take my example. I've been in my house for 25 years. Should I decide to move, which I'm not planning on moving, now my house, let's say it's worth $1 million. I'm just throwing a number. Let's say I bought it for $250. It's quadruple. It's $1 million. Now I'm going to move to Montana, where my kids moved, as an example. If I go there, I can buy a house for $400,000 or $500,000 cash. But if I sell my $1 million home, I'm going to have the gains, because obviously I didn't pay $500,000. So, my gain is a lot more than 500. Then I lose a lot of money by paying all these taxes. So it's a curse to have equity, but it's also an advantage to have an equity. The other thing that's happening, and I wanted to bring this up earlier, is if you combine the capital gains tax, which we're talking about here, and let's say I had a loan on it, I refinanced and I had a small amount of loan, right? And I have 3% on it. Now, if I go to Montana or wherever, and if I didn't want to pay all my cash because I want to buy stocks and get some tax write-off or whatever, so I buy a house with a loan, I'm not going to pay 7%. So if you combine the equity taxes and the loss in my interest rate, that's creating a havoc too. And that's part of the shortage, because people are not moving because of the low interest rate, and because of equity, they don't want to pay taxes on it. Or, so what do you have to say on that, Matthew?
Well, these are rich people problems.
Okay.
They're good problems to have. You're gonna get taxed. I wouldn't be that concerned, because the tax is it's not 20%. Let's just say it's 20%. It's not 20% of the price. So you're not going to sell the $1 million home and have a 20% gain, that 20% tax bill. It's 20% of the gain that's above 500,000. So if you bought a home for 300,000 and you're selling it for $1 million, so your first 500 is tax free, you're only going to pay 20% of the 200,000 above the 5, if that makes sense.
Right.
Which is a lower number. And then there are certain capital improvements that you probably have made to the property during your ownership that can increase your cost basis as well.
Right.
And basically lower the amount that you have to pay tax on, lower the gain amount legitimately. So,
Absolutely.
so, when you combine all of that, you might get a $5,000 bill or whatever for taxes, but it's not a reason to change your entire life plan, over that.
Right.
So.
Yeah. I want to touch on this report and read up a little bit so we get a more understanding. Realtor.com, it says that millions of American homeowners are sitting on a hidden tax burden they never planned for, one that threatens their hard-earned home equity and at the same time is tightening the nation's already strained housing market. Today, roughly 1 in 3 homeowners, that's up 33%, nearly 29 million households have built up more home equity than the federal capital gains tax exclusion for single filers protects when they sell their primary home, according to a recent analysis by the National Association of Realtors. By 2030, that's in 4 years or 5 years, that number is expected to grow to 56% of the homeowners. What that means is in 2030, 56% of the homeowners are exceeding their limits on capital gains. That's a huge number. But let's look at some states where, this talks about where homeowners are over the home exclusion limit. Obviously, look at California at 62.2%.
Yeah, that's crazy.
It's huge. What's one of the lower states there? North Dakota is 16.7%. Yeah. Arkansas is 20. Alaska is 22%. Hawaii, look at Hawaii, 80% of the homes are over their equity limit.
Yeah. What is Georgia? I can't see the numbers on there.
Georgia, let me see. Where is Georgia? It's right there.
It's right above Florida.
Yeah. 31.3%.
Okay.
Yeah. Florida is 47%. South Carolina, the neighbor, is 28%. And Alabama on the other side is 13%. Yeah. So let me read one more paragraph here. Most people don't think of their home as a taxable investment. It's their nest egg, future college fund, or inheritance for their kids. But an outdated federal rule left unchanged since 1997 means the longer you stay and the more your home appreciates, the more likely the IRS will claim a cut when you finally sell.
Right.
The home equity tax has big consequences. It erodes family wealth right when people need it most. It discourages older owners from downsizing or moving closer to care. Okay. And it keeps larger family sized homes off the market, fueling the inventory crunch that's driving up prices for everyone. So it kind of all, if you look at it, it all makes sense. It's not just inventory is low because of interest rate and there's bigger demand, but there's other issues like tax gains. It is an issue. If I have to sell my house today, not that I'm planning on selling, I will have to strongly consider and maybe talk to my accountant and say, hey, how much am I going to lose in taxes and moving and
right. Although, it could be argued that someone like me, I'm in this stage where the gain on my house is right around 500,000 from when I bought it to now. So on some level, that has encouraged me to think maybe I should sell my house now so that I can get out before, because if it keeps going up in value, I'm going to start getting taxed. But if I sell this and buy a different house, it resets and I get a whole other 500,000 tax free. Right. So it could encourage some people to sell if they're right at that threshold.
Yep, absolutely. So I want to switch some gears, Matthew. One of the things I want to talk about is what most people don't know, right? And I'm talking about a typical homeowner, maybe a home buyer, because home sellers become home buyers, is what can you do to minimize your taxes? And maybe I'll let you talk about it, but here's some topics and you can talk whatever you feel comfortable with. Some things you can do to pay less tax should you decide to sell. So let's say you're planning on selling, or I'm planning on selling in 2 years. What are some things I can do to minimize it, or even in a couple of months? Number one, and I'll tell you these points, you can talk whatever you feel comfortable with. Number one is stepped up basis explained. Holding holding until death to avoid taxes, borrowing against equity instead of selling, like a HELOC or refinance,
Mhm.
and then prospective home equity tax, not just capital gains tax. So
Okay.
whatever one you want to talk about, just
Yeah, I mean,
explain.
I'm comfortable with all of them.
Okay,
all
so
of
just
the above.
give us a
The first
give us
two
a
are kind of
breakdown.
identical. The first two, the way I understood it, was they were kind of the same thing. It was talking about a step up or holding the property till you die to avoid. It's the same idea. And this applies, by the way, to investment properties like rental properties as well.
Right.
And I know this very well because I own rental property, and the thought has crossed my mind about selling because they've gone up so much in value and everything, but I'm not doing it because I would have to pay those taxes, and I don't need the money right now, and it's basically the goal of that money is to, eventually it's going to be my daughter. So if I hold the property, then whenever I die, which hopefully won't be for another 150 years, but
Okay.
at some point, my daughter will inherit the properties, and she'll get what's called a step up in capital gains, which is the whole thing resets. So she starts out on day one, whatever the house was worth at that time, it's zero gain. And then she can get another, whatever, 500,000 in gain and sell without owing taxes.
So what you're saying, just to clarify, let's say something happened and your daughter gets the house, and that at that time, 20, 55, whatever, right?
Yeah.
If that house was worth $500,000, you paid 50,000, but at the time of the transfer it was 500, then her step up basis is 500, not 55,000.
Yeah, her cost basis becomes
Cost
that's
basis,
the step up in basis. So that takes care of the first two. What was the third item on your list?
Borrowing against equity instead of selling.
Yeah, that's also, I do that as a lender quite a bit, and I've done it myself for myself because I didn't want to sell. So you've got all this equity, you want to do something with it. A great way to do that is to take a home equity loan or a home equity line of credit. You don't have to sell the house. With a home equity line of credit, you don't even have to pay any interest until you use the money. You can set it up and have access to write checks against the equity in your home and only pay interest for the amount that you drew while you owe it. And as you pay it down, your payments go down also.
Right.
So those are great ways to tap into the equity, and you can get up to, I'd say 85, maybe even 90% of what the property will appraise for in total loan to value.
Right.
So
yeah,
that's a good option.
So one of the things I had in mind when I read the stepped up basis explained, I wanted to also clarify, let's say I didn't do it, but let's say I bought a house 20 years ago. It was a 3-bedroom. As my family grew, I built another room, right? I built an extension, cost me $40,000, $50,000. I added a pool, blah, blah, blah. When I sell the home, it's worth $1 million, but I spent 50,000 for the room, 100,000. So I thought that was a step up basis.
Well, I guess that's a different way of stepping up the basis.
Right.
One is dying, and
that's what I had in mind, so.
But yeah, so you can, like I kind of touched on that before. Any certain capital improvements, like building an extra room onto the house, are things that can go into your cost basis. So if you bought the house for 200,000 and you put 50 to add a room, it's as if you really paid 250.
250, right.
And
so I just want to clarify that adds, because people build things or build an ADU these days. So
right.
I just want to make sure that clarify that there's two ways for step up. One is when the transfer of title, that's a step up basis one, but it also cost basis also goes up because there's two distinct.
Correct.
So there's a clarification, so.
Correct. And
Because I
then
also sell a lot of investment properties, and we also flip them after 3, 4, 5 years. When he goes up, we sell them. And the accountant, they ask me, how much should I add? I say, don't ask me. When you paint it and this and that, some of it is adds and some of it doesn't.
some of it is, some isn't. I don't even know what
Yeah.
what qualifies.
You can
and-
answer that. Yeah.
yeah.
Right. Like if
So,
your toilet's broken and you put a new toilet, that's really maintenance and not an improvement unless you improve your bathroom or do something. So
it's pretty obvious if you're adding finished square footage, that would be a qualifying improvement, I would think.
Right.
But when it comes to replacing things that wear out, like a new roof or whatever,
Right.
I don't know if those count or not.
Right.
So, and then you talked about, I think the last one that you mentioned was about the proposals that are out there to tax capital gains before without you selling. I've heard some people talking about that. That is, in my opinion, is just crazy talk.
What do you mean, like before selling?
Yeah, there were proposals out there to make people pay capital gains tax even if they don't sell the house. Like your home just appraised by the county appraiser for more. So that's just the government trying to grab, because people are staying in their homes longer now. They're feeling the pain of not getting to collect those capital gains taxes. So they're like, well, how can we get them? And they were talking about, should we tax without, like, at the time they gain without the sale? But that's just that is ridiculous. That is.
But here's what I heard also, and not talking politics, but there's also talk that they're not going to charge property tax for seniors. So on one way, you're taking away property tax if they do, but on the other hand, you're charging them capital gains tax. And a capital gains tax is when you execute it. So there's no gain unless you execute it, right? So
that's the way it's supposed to work.
Yeah.
I mean,
it's not a gain until you do it, right? I mean,
no, and values.
Crime is not a crime unless you shoot somebody.
Yeah, and how would you feel if the value goes up and you pay this capital gains tax, and then the value drops? They're not going to hand your tax money back to you if the value does go down in the future. It just can't work that way.
Right. I haven't heard that. Is that in the big beautiful bill out there? Or
no, it was the opposite. It was actually being proposed. I think it was. I don't want to. I think it might have been. It might have been a Nancy Pelosi suggestion. She might have been the one that originated.
Yeah, I mean, California. I know everybody hates California.
Yeah.
But the reason I think people hate California, one is expensive gas. It's the most expensive. It's very expensive real estate, right? And also because it has beaches, it has desert, it has snow. It's all the good places.
Yeah.
So, but
it's a nice place.
Nice place. It is expensive, I can tell you.
Yeah.
I think somebody was telling me that in California, to be able to rent something in California, you got to make $100,000 minimum.
Yeah,
$100,000 just to be able to rent something on average.
Yeah, I think we actually got a comment, but it's just a hi. But
okay, well,
like to acknowledge
welcome any comment. Yeah,
and feel free to ask us anything.
Yeah.
Well,
okay.
I guess.
Okay. Let's see if you have any question. We'll answer it. So in the meantime, I want to switch gears if it's okay with you. I want to switch gear a little bit. Okay. Let's see. Okay. We'll ignore that. We'll kind of, let's see. We'll just move on that one.
Where should I buy? Ragnar says. We don't even know what state you're in.
Right. Yeah.
Okay.
Yeah. Okay.
That's a nice one.
All right. So let's move on to the next topic, which I think is important, kind of related to this equity thing, is what's happening to homeowners, like seniors, for example, right? For example, again, I'll give you 2 or 3 points that came to my mind, which I wrote down. And I'm old school. I'm using a paper. I'm not using my phone. I'm using old school paper. So what most people don't know is, number one, we talked about it. What are the real consequences for homeowners regarding the capital. Number one, it's seniors stuck in unsuitable homes. If I'm a senior on a fixed income, let me see here. How do I take this out here? Okay, hide.
Okay.
Okay, got it. Okay. Okay, I can see you there. Okay.
Yeah.
Okay.
That was I just commented to have
Okay.
it
Oh,
go.
no problem. Yeah. So anyway, so what are the drawbacks? Okay, let's take my example. Mine in the sense I've owned my house for 25 years. Let's say I'm fixed income, I have medical issues, my kids are all gone, I'm on my own. I can't sell my home. My house is old, haven't fixed it. It's too big for me, but I can move. How serious is that issue right now for seniors? In other words, are a lot of seniors or people stuck in unsuitable homes where they can't sell because they can buy another one or they pay too much taxes, etc.,
Right.
etc.?
I have some great solutions for that,
Okay.
which I'm sure exist where you are as well. But I've partnered with several companies that will help people like that
Uh-huh.
get their home fixed up without any upfront costs. They
Right.
get paid at closing out of the equity. And they would, there are even other products that I have where you can get a large percentage of your equity up front before you move out,
Mm-hmm.
and then go buy your new home, and then and you can become a cash buyer essentially, and
Mm-hmm.
make a non-contingent offer on a new home. um, Move directly into it. It does cost a little bit of money.
Okay.
There's basically companies out there that'll front the money to you as long as your credit's good. They'll loan you the money um, to kind of bridge that gap, and also to fund the renovations and repairs that need to be done to maximize the value of your existing home.
Right, right. Okay. Okay. If they didn't have that, if they did not have that option, it is a drawback to the seniors, right? And in fixed income people, low income people, medical issues, they're stuck in there, right? In a way.
Yeah, I mean, you can always sell any house in any condition. It's just a matter
Right.
of and if it's a senior's house that they've lived there for a really long time, chances are even the price that an investor or flipper will buy it for is going to be a lot more than they paid for. They're still going to
Right.
have quite a gain.
Right.
But so, yeah, I mean, you can always sell. Like I always tell people, I can sell any house in any condition, in any neighborhood, any market conditions in one day.
Right.
Always.
Mm-hmm.
And I can guarantee that. The only thing
Right.
that's going to change is at what price.
Right.
And
Right.
that fluctuates with the market.
Okay. Cool. Okay. What about emotional and financial stress for not being able to sell and thinking about, oh my gosh, I got too many taxes and this and that? How serious is that issue? I don't know if you come across anybody, or read some reports on it, or what is this a major concern? Or
It's definitely a concern for people that are strapped, and the fear of having two mortgages is a big thing. And what I see a lot of people do, which is not always a good idea, is there are companies that take advantage of people's fear in that, and
right.
offer them kind of we'll buy your house, um, so they know that they've sold the house and they don't have to worry about the buy and then sell kind of thing.
Right.
But the price at which they buy is very, very low compared to what you would get if you just put it on the market.
Mm-hmm.
So
Right.
it's always smarter, especially if the home's in decent condition, to put it on the market and take that risk, because you're going to end up better off.
Right.
And again, the house will sell. It's a guarantee.
Yep.
It's just the only thing you don't know is what is it going to sell for. But you can even tell that plus or minus 5%, let's say.
Mm-hmm.
So
Yeah.
worst case scenario, you're going to sell it in one day, fire sale price.
Yep.
That.
Right.
And then you try for more, and
Yep.
usually you're
Absolutely.
going to get more.
Right. Yeah. Yeah, I think it's a lot of issues where a lot of people are stuck. Maybe not over here. Let's take an example of Florida. I read a report regarding Florida. This lady, and I've used this example several times. She's 72 years old. This is what I'm talking 2 years ago when the disaster hit. The hurricane hit, and before
Mhm.
that, the collapse of that building, which initiated the new state regulations where they had to do reassessments, and they were hit with assessments. So this lady was number one hit with an assessment. She's been there for 25 years, 20 years. She's been there for 20 years, never been late on her payments. Never once has she been late in her payments. She's on fixed income. And then after the hurricane, Ian, I think there was a hurricane Ian and the one Milton,
Oh
those
yeah.
two happened back to back. So her
Mhm.
house got damaged. It was a condo, actually, not even it was a detached condo, but it was a condo where it's not a high-rise building, but those attached condos. So hers got damaged. So one, she had to pay for the damages, which she does not have money. She's one of those that is equity rich. She has a lot of
Mhm.
money in the house, but not in a savings account. So three things happened to her, and she's in distress and she cannot sell her house. Number one, her HOA went up because insurance went up.
Yeah,
Her
it's
insurance
happening a
went
lot.
up. Her individual insurance went up. Her HOA went up. At the same time, she was assessed. I think the first year she was assessed with $22,000 up front. All of those condo
Wow.
owners, right?
Yeah.
She doesn't have the money. So she put it up for sale, but she cannot sell it because his house is not well, because it's not fixed. Number one, she has no
Mhm.
money to fix it. The outside and the roof, the HOA did it, but there was other things she had to fix. There was damage
Mhm.
inside because the water came in, the glass broke, blah blah blah, right? Does not have money to fix it. Her HOA went up, her insurance went up. She doesn't have 20,000 to pay. She could not sell the house. She was almost, I don't know what happened, but she was served a foreclosure. But I think there was some people in state were trying to help. I should follow up on that story. And
Mhm.
this is where it's happening, where a lot of Americans, especially the seniors, especially the people who are on fixed income, and this saying is becoming very popular, is a lot of the people are equity rich but cash poor. Imagine me, I'm fixed income. I've been here 30 years and I have $1 million in a home. But if
Sure.
something happens, I don't have money to fix it. If
Right.
my window breaks, I don't have $20 in my saving to fix it. That's a
Right.
sad situation that's happening. And
Well, I mean, they have options. If they have equity, they like you talked about, they can tap the equity, getting some kind of home equity line of credit or
some
something.
can and some cannot, because some people have bad credit.
Right.
They were behind on payments, behind on HOA, so their credit is bad. So they cannot refinance, and they cannot buy a house because they cannot get a loan, or they cannot move because, hey,
Yeah.
I'm a senior. My son lives 10 miles away. He comes and helps me. I can't afford to move. If I move, I have to move to Timbuktu where the homes are $200,000. I can't do that.
Hmm.
So I'm
Yeah.
stuck. So this is a senior pandemic that I'm seeing. I hear a lot about this story where a lot of people want to move, but they can't. I did a
Hmm.
video a couple of months ago where it says that Americans are struggling. They cannot sell the home. They cannot afford to sell their home, nor can they afford to stay in the home. A lot of
Hmm.
situation like that. If you look in Florida, especially with all the hurricane, and I hate to bring up
Florida's
Florida all the
getting
time,
clobbered on that.
a
Yeah.
disaster.
Especially the condos on the coast. Boy, am I glad I didn't buy one of those. I
Oh,
was
okay.
thinking
Were
of
you
one
thinking
of
of
them.
buying there, or?
I was actually looking at one time getting a vacation place, Airbnb-ing it out, but
Mhm.
I'm glad I didn't. Um, but um, but yeah, I mean, there's always people. There's always going to be people in unfortunate situations.
Mhm.
Some of them I can help with those companies I was talking about that will front the money for repairs. I have sold condos before with special assessments and very
Mhm.
high HOAs. The special assessments can be paid with the equity at closing, so they can agree to pay that out of their equity and still, get out of the house and have that
Right.
paid for the buyer. If the dues just went up, what I did on one property and it worked, I was actually kind of surprised, but I was like, you know what, people, I was tasked with a mission to sell a
Mhm.
condo unit, and the
Right.
condo had something like that.
Right.
Um, I realized, generally people are short-sighted. They look at how much is this going to cost me for the short term.
Mm-hmm.
And so what we did is the seller prepaid the HOA fees for 1 year.
Right.
And we sold the place with advertising no HOA for the first year.
First year.
We already paid.
It makes a big difference. It makes a big difference.
It worked.
Yeah.
A buyer, bought it. I don't know what happened afterwards. They were able. I mean, they certainly knew what the HOA fee was going to be, and the lender had to calculate it into their qualifying.
Right.
But I guess they felt like, I'm only going to live here for a couple of years. So, and if one of them is already paid, then it won't be that bad.
Right. So I want to switch gears and ask you a question where it's been on my mind. And when we talked about mostly seniors getting stuck in their home, and you're a lender, so I can ask you this question. And I know a lot of the audience will know it, but some of them may not. Can you talk about reverse mortgage, good and bad, plus and minus, whatever, just a brief so that, it could help some, it could not help some.
Yeah, I've had people inquire about reverse mortgages with me. I'm not currently doing them.
Right.
I probably can. I'd have to find a wholesale lender, to run them through or whatever. But I don't believe in them really.
Yeah, exactly. My point. But at least they know the option is there. I personally don't recommend it, but at least let them know that it's something like this is there.
Yeah, I like to sell products that I believe in, where I actually think it's good for the consumer. Generally speaking, all a reverse mortgage is basically if you have a lot of equity in your home, the bank will give you a check. They'll pay you each month, So let's say I have $200,000 equity. I could have the bank send me a check. You're turning your equity into an annuity. So the bank will send me a check. They'll pay, let's say $5,000 a month. So the first month I have 200,000 equity. Then they send me a $5,000 check. Well, now I only have 195 equity, but I got 5,000 of my.
One quick question: while you're doing that, do they have a loan at this time, or is paid off home? Just to
I think you can. I'm not sure if you have to have the home paid off to qualify to even do this.
You can have another loan, and I can use the 5,000 to pay my first
another
mortgage.
loan as long as you have enough equity.
Okay, got it.
But yeah, I mean, it's basically just having the bank give you the equity. It's kind of like a home equity loan, but taking an automatic draw on your equity each month. And then there's no payments. You don't have to repay, but you're paying in the form of eroding away your equity. Okay. The downside of this is, first of all, those things generally come with tremendous fees. They're not as regulated as home equity loans and things like that. So lenders will just charge ridiculous fees and
I heard they charge 3% to get the loan.
Yeah, and they can charge whatever they want. And a lot of the consumers don't even realize how much they're losing of their equity because they're not making them pay it in cash. They're just taking it out of their equity. So it's like, wait, you mean I just signed these papers and you send me $5,000 a month? Sign me up, And they don't realize how much they're actually paying that lender to set that up, and how much they're just eroding their equity away. Generally, it's much smarter to either take a home equity loan or line of credit, and if you can't get one on your own, perhaps get a co-signer or someone to help you out, a family member or something, or sell the property and get your equity that way. Those are, really the better options for almost every scenario. I'm not going to say that there could be one or two cases out there where it's appropriate to look into the reverse mortgage, but
what are the interest rates on those reverse mortgages? Not that I like them. I would strongly stay away from it.
I don't even know because I don't do them, but I imagine that the fees and the rates are probably
sky high.
Sky high. And
they're taking a big risk, right? If I'm a lender and there's a first, if the first defaults, then I'm out, right? The second is out.
Yeah, but it's not really a loan. You're basically, with reverse mortgage, you're using your equity as the collateral.
Mm-hmm.
So
Mm.
you're not, I don't think they worry. There's not like, I don't think there's a qualifying kind of thing where you have to have
Oh,
good
okay.
credit and income or
They just
anything like
okay.
that. That's the one benefit of them, why some people do them.
Right.
Um,
Okay.
so
Got it. Okay. Okay, so before I forget, last week I forgot. I want to mention that I know that my viewers are from everywhere. They're from Atlanta, they're from Texas, they're from Washington. So I was asked this question offline. So I want to show you a screen here. If you guys that are watching or watching the recording, if at any time you're looking for a realtor that can help you out, I want to show you. Let me see a screen where I have on my website. If you go to my website, there's a link on the description. You can see a form. It's called Realtor Referral. And all you do is fill this form out. And if you have any questions and if you want to talk to a local realtor, because obviously I can help you answer questions, but rules in Texas are different than in California. So if you're looking for a realtor or a lender and want to talk to somebody about what to do about your housing, retirement, what we talked about, equity, fill this out and I'll be glad to refer you somebody right in your neighborhood that is skilled and trustworthy. So just keep that in mind. And of course,
yeah,
if you want someone in Atlanta, you're going to call Matthew Sher. And
yeah, and I'm
Matthew,
putting I just put a link to my
perfect. Right.
website in the chat, and that has a way to
That's your
contact.
website, realestateforatlanta.com. Easy to
Yeah,
remember.
yeah,
Let me see if I can show it on the screen. There it is. Realestateforatlanta.com if you want to write it down.
right.
All right. So let's move on. What I want to talk about is, if I'm thinking about it, I wrote down here, it says, what can you do to avoid capital gains shock? One of the things we talked about is that if you did a room addition or something, you can step up your basis, right?
Yeah.
So, what are some of the things to do? One of the things I wrote down was document all improvements so that you have
Mhm.
improvement, right? Because if your accountant asks you, okay, how much did cost you to build that extra room, you better have documentation, because it
Yeah,
could have been 10 years ago and now you have to sell because you got a job relocation or whatever, right? So document all improvements and have invoices ready, because we're not going to go there, we're not accountants. uh, you can consider renting or a 1031 exchange if it's not owner occupied, right? Or you could buy another house and rent it out, so you don't have to pay the capital gains tax. If you can afford it, pull equity out, like you're talking about. Pull equity out. In my house, I
Mhm.
can pull money out, go to Texas, buy something. In the meantime, I'm renting this property out. And then after 2 years, I can sell it and do a 1031 exchange and save taxes. That's another thing you can do. Or you
Yeah,
can just go buy something, keep this as a rental. Now you have two properties,
right.
right?
Yeah,
And again, always talk to a real estate CPA or an estate planner before you do anything. We're not accountants, we say things in general, but
right.
each scenario is different. So again, we're not lawyers, we're not accountants.
Yeah, and a
We
1031 exchange does not exempt you from the taxes. It just kicks the can further down the road.
Mhm.
So it allows you to buy another property and not pay the taxes now. But whenever
Right,
you sell that property, you're going to pay the taxes for both gains.
right. So that's why they call it the delayed 1031 exchange, because all you do is
Yeah,
delaying property taxes from now to, let's say your daughter gets the property, and when she sells it, all the
right.
exchanges that you did, she may have to pay all that,
Yeah. Now, what
right?
what a lot of people use 1031s for, which is a popular thing, is, let's just say residential real estate is, it can be time consuming. You can have bad tenants, you can have all kinds of stuff go on,
Mhm.
and they're usually just 1 year leases, and the landlord's responsible for all the maintenance and all that kind of stuff. So a lot of people get tired of that, including me,
Yeah.
and start looking into, you can do a 1031 exchange, sell some of your residential properties, exchange them into commercial properties. Okay.
Mm.
On commercial properties, you can get what's called a triple net lease, where the tenant pays for all the maintenance and everything. And you're talking 5, 10, even 20-year leases.
Wow.
So you don't have the turnover of having to find new tenants every year and all that. So a lot of people will want to kind of get out of they start in residential and then they want to foray into commercial.
Yeah, you move up, right?
And one way to do that is an appropriate scenario for looking into a 1031 exchange, because it does still qualify as a like-kind exchange.
Exactly.
To go from
what you're saying is, if I had 2 or 3 homes, let's say I had a 2-bedroom, 1 bath, and a 3-bedroom, 1 bath, and another small house, I can sell all those 3. I can potentially buy a commercial. Or what about multi-units, 15 units, 10 units,
Sure.
16 units? And those are easy, right? Because I think to manage it, you have to have over 16 units, you have to have an on-site manager, right? So it's easy for them to do, right?
That may be a California thing. I don't
Yeah, California, if you have over 16 units, then one of the units, the manager must be on site, anything over 16 units.
Okay.
But the advantage is that, when you do an exchange, the more units you buy, the cheaper it is per unit, right? Like if I buy 8 units versus 16 units, the cost per unit is cheaper.
Price per door goes down.
Price per door is cheaper. And of course, jumping from 3 homes, like I can sell 3 California homes and go to Texas and buy 20 units because of the price difference.
Sure. Yeah.
And I can exchange out of the state as well, right?
Yeah.
It doesn't have to be in California, or I can go anywhere.
Yeah. I think you got to stay within the U.S.
Right. Well, of course. Right. Yeah.
That's it.
Right. So that's one way to do it, is renting it out. That's the thing. But you cannot do a 1031 exchange if it's your residence. So you cannot, only on rentals, that you have to have that house.
It wouldn't make sense because usually you have that capital gains exemption on your primary residence. So although nowadays, like we talked about, that is coming up more than it used to.
Right. Yep. Okay. So last thing I want to talk about, or not last thing, but one of the things I want to talk about, do you know of any, or what is your opinion, especially for states like California, New York, Hawaii, New Jersey, certain areas where home prices have really jumped high? I mean, the median home price in USA is $400,000, $450,000, according to the chart that we saw. It's around $450,000. I just sold a 1-bedroom, 1-bath condo, 500 square feet, just closed escrow last week for $460,000. So what I'm saying is, in California, the 500 doesn't make any sense, because it can, house can double.
And that needs to be revisited. I don't know. Like a lot of things they came up with, it's very weird to have the same capital gains exemption at a federal level nationwide when the prices of homes are so vastly different.
10 times different. What you can buy for $400,000. One of my clients just bought a house in Wisconsin for $400,000, $450,000, brand new house. 3 bedrooms, 2 bath, about 1,800 square feet, but with a basement, brand new. That house in California, that brand new house, 2,000 square feet, would be more than $1 million in Southern California.
It would make sense to have the capital gains exemption adjust for cost of living changes in that particular city.
Do you know of any bill that's out there, or anybody trying to do anything about that, or anything?
I don't, but I'm not someone who really keeps up with politics at that level. So
who listens, right? Who listens to you anyways?
It could be, and I just don't really know. When it becomes a thing that's actually about to pass, I'll worry about it then.
Well, any last comments before we close the door?
No, not really.
Okay. Well, all I can say is, if you are in a situation you need some help, or even if you need an attorney or somebody, we have a network of attorneys as well, because we have a network of top agents and lenders, and they have a network of attorneys and accountants. Let us know, hit us up, fill out that form if you need to contact us. But we thank you for watching. Make some comments on where you are, what's happening in your neighborhood. And Matthew, thanks for coming along. I hope you don't mind if I call you again as a guest.
No, thanks for having me. I really enjoy doing this.
All right. And, thanks, everybody. We'll talk to you next week. Join us again at 4:30. Mike Patel at Home Service Central. Thanks a lot.
All right. Thank you. Take
Bye,
care.
Matthew. Okay.
Bye-bye.